It's a contract between you and the life insurance company, right? You're agreeing to pay them every month, every year, whatever. If something happens to you, they're agreeing to pay a large sum of money to your family. In my opinion, the money's not that important. I mean, money's important, right? You got to do everything with money, but for our family and our financial situation, I'm more worried about the freedom and the flexibility that it gives her. I'm the sole earner, and she stays home with the kiddos. If something happens to me, I want to make sure that she's got time to grieve, and she's going to miss me a lot. I'm a nice guy. But also, does she want to go back to work? When does she want to go back to work? Do you want to make sure the house is paid off? Do you want to make sure the kids can go to school? Right? So it's not so much the money, but it's the flexibility and the time that money can buy. Oh, I need my footballs. Hang on. You don't answer.
You don't know the answer to your own question?
I know the answer. I dropped footballs.
Oh, okay.
This is gonna hurt. These are magnetic football can openers, is what these are. So they're somewhat useful, and they have my name on it. What type of coverage is cheapest?
Term.
It depends.
It's usually term. It's usually. All right, there's a lot of info on this page. I'm gonna try to make it not insane. So there's two categories of life insurance: term and permanent. There's a bunch of other things that fall under permanent, but that's the difference. You want to rent your insurance 10, 15, 20, 30 years. You want to buy it. It's universal your whole life. Terms are going to expire after the term ends, or they're going to jack the rate up a lot and make you want to quit. Terms typically going to be cheaper, but you don't accumulate cash. So it's like renting a house, right? You get to use it while you're there. When your lease ends, what are you going to do? Permanent insurance is more like buying. Keep it for the rest of your life as long as you complete your end of the bargain and you pay your bills. You can also accumulate cash. We'll talk a little bit more about that later. You can accumulate some cash value, some money for yourself. And yeah, owning a home can build equity. Nah, not you. You already
Too
got
fast.
C.
It depends.
It depends.
It depends.
Deep for things.
It's not necessarily till you pass. If you got a term and you don't pass in 15, 20 years, it ends. Yeah. So I want to talk about one of the ways that you can build tax-free wealth for yourself is indexed universal life insurance. Anybody heard of that?
Yes.
Other than you. You can get out of here.
He cannot answer the
Answer
He's
any
banned.
questions.
Yes.
Anthony's also life insurance professional. Yeah. So the couple main benefits, I wanted to highlight Index Universal Life because I've seen a lot of it on social media. All the social pros talking about it. Hey, it's great. If you structure it right, it can be great. If you structure it wrong, it's awful. A couple of the main benefits: the 0% floor. So within that permanent life insurance policy that we talked about, you can build cash value. There's a couple of different ways they'll credit you interest on the cash value. The index one, or Index Universal Life, it's going to track an index like the S&P 500 or the Dow, one of the other stock market indexes, and they'll credit you part of what that index earns. So if the market earns 25% in a year, they'll cap it usually around 9 or 10%, you'll get 9 or 10%. If the market drops 20, 25%, you lose nothing. That's the trade-off, right? You kind of smooth out the returns of the market. You don't get all the highs, but you don't take the drops either. You can preserve your gains. Again, you don't take drops. You don't take the drops in the market. The tax, that growth or that interest that they credit you is tax deferred. You don't get a tax form at the end of the year. You don't have to go talk to Dane and report it on your income tax because it's in a life insurance wrapper. You can borrow against that cash without any tax implications, but if you withdraw it, then they're going to want to talk to you. So how's it work? How's it work? You fill your part of the bargain, part of the contract, right? You pay them the premium. Some of it goes to the fees. It's still the life insurance. You still have to pay for the life insurance. Then the rest of it goes into that super supercharged savings account, the cash value account, and it will be credited based on fixed interest rate or that index allocation. And then, later on, whenever life happens, doesn't happen, your beneficiaries get a tax-free death benefit. Take some money out via loans.
There's a question over here.
Question from the tax guy, I'm in trouble. What do you got?
So I was at InvestFest this past weekend, and Steve Harvey was talking about how he actually borrows from his term policy. There's a cash value in there, and if it's $1 million and he borrows 100,000, then it just reduces the death benefit from $1 million to 900. So he will use that $1,000 to invest, or if it's somebody who's so like that. I thought it was a really good idea or method to kind of go about it. He's like, screw my family, like you know, they're gonna get $100,000 more than what they want, that's fine. But I thought it was an interesting take on it for sure.
Yeah, yeah. To my understanding, you can't borrow from term, but you can borrow from the permanent ones. It will, if you take a loan and you don't pay it back, it will reduce the death benefit, the money that your family gets. One of the most powerful things you can do with it, once you build up that cash value, is borrow against it and invest in something else.
Sure.
Because the loan rates on these are are better than most any bank rates. Last I looked, they're like 5.5%. Very difficult to borrow money on that. But if you're growing a business, if you're going to invest in real estate, you borrow on it and kind of double dip, especially with a rental property. I set one up a couple of years ago for a buddy who wanted to buy rental properties. Unfortunately, his business went under. He didn't actually do it, but his plan was to buy to buy rental properties, and as the rent comes in, pay the loan back. So a couple of years down the road, the loan's paid back, and you can do it again. You can do it again. Yes, thank you. That's amazing. Why is 0% powerful? When I first got into the investment industry years ago, it kind of bothered me that they quote all of their returns in percentages. Because if you lose 10% and you gain 10%, you're not even. Yeah, the math doesn't math. It does math. I like bigger numbers because it's easier. But if you say you lose 30, you got 100 grand, you lose 30%. How much do you have? Bookkeeper, 70 grand. Yes, love it. And then you earn 30% on 70 grand, which is 21, and you've got 91. You're not back to your original measure. That's all. It's big. That's all. The point is there. Can you use life insurance before you die?
Yes.
I should have had this in a different place because yeah, you can. We just talked about it.
Yeah. Football.
Got a
Thank
football.
Uh-oh. Be careful, watch your head.
There's flying footballs everywhere. This is an example, an illustration of an IUL that I set up for a kid. One of the ways you can save for children. Dave's going to talk about another that's fairly new. Before that came out, there was very few ways that you could save effectively for kids unless it was specifically for college, like a 529. They can't own their own stock. They can't own their own real estate. You can put money in savings for them, but it's like earning 0.5%, maybe 1% now. So this one was a 9-year-old. We put in $200 a month. Account value after the first year was $1,932. So about 500 of it is going to pay for the actual insurance. Over time, he earned some money, he earned some money, earned some money, earned some money. At age 39, this account, assuming the market does what it's supposed to do, it might do better than this account would have about $187,000. Even at 29, maybe he's looking to buy kid's looking to buy the first house, as a family, 81 grand. And again, if they borrow from it, don't withdraw it and close the policy, they can pay it back and keep it for the rest of their lives, right? This is a similar, but this one was for an older gentleman, obviously older than I, right? 31-year-old who was making a little more money, he's putting 10 grand a year into the policy. Scenario, the numbers are similar but bigger because he put in more money. At 56, he's got $633,000. And if he didn't take it out, it's almost $1 million for his family. But again, borrowing from it's tax-free. Can you borrow from it every month and pretend it's a pension? Yeah. Yeah. All right. So minimum age to be eligible for a life insurance policy.
2 weeks. Your wife
Did I
said
give you
first.
one already?
Yeah. Your wife said first.
She did say that first. It's like a dozen of these in a box. That's all right.
So the answer was 2 weeks?
2 weeks, yes,
Okay.
sorry, 2 weeks, yeah.
Yeah, that was social security number, right?
Oh, yeah, that makes sense.
Usually 15 days, but that's
Close. Splitting hairs, Anthony. I'm gonna step on Dane's toes a little bit and talk about tax strategy, but just for investments, don't worry. So when you're investing, when you're saving money, there's 3 ways that money can be taxed. It's either taxable now, later, tax deferred, or not at all. I'm specifically talking about the earnings, if you want to get granular on it, that's all right. Taxable now is stocks, bank accounts, crypto, anything that you hold at the end of the year, the investment company, the bank's gonna send you a 1099, you're gonna have to take it to this guy and report it on your taxes, right? Tax deferred is your traditional IRAs, 401ks, pensions. If you access it before retirement age, they penalize you. If you access it after retirement age, they still want you to pay taxes on it, because when they withhold it from your paycheck in a 401k, then they're taking it out pre-tax, right? And then this is what we're talking about: cash value life insurance, Roth IRA, munis. Muni bonds are boring. We can talk about them if someone wants to individually, but they're fun. Where would you want? Let's pretend we're all in the future. We're all in retirement. Where do you want your money sitting? In which bucket? In all of them?
Never.
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 Never. Yeah.
But I would have to argue that the Roth IRA is not never because it's taxed now.
Right.
So it'll ultimately be in the never.
But ultimately, never. Yeah. I mean, if we're pretending we're in the future, and then you're not paying taxes on it later.
Like, let's
Alright,
pretend
we're-
we're like
we're-
70 years
we're in
old.
2050.
All right, tax. Calm down. Calm down. So ideally, as a financial advisor, you actually want a little bit in each, because there's a standard deduction. So you can pull some money from this each year if you don't have a whole bunch of other income sources. You can pull some money from this each year without actually having to pay taxes. The standard deduction is pretty high right now. I have a neighbor, potential client, hopefully. He did a great job saving. He was a VP at a company. He has a significant lump sum in this area, and he's about to turn 73. So they're gonna make him take money out of here. It's gonna make his Social Security taxable. His Medicare costs are going up because that's increasing his taxable income, and IRMA exists. But I guess the point is, yes, want a little bit in each, just so you have that flexibility in retirement, right? So you can choose, and Dan can help you choose where you want to take it from. I promised I'd talk about it a second. We'll hit the Roth IRA fairly quickly, because I think most people are aware it exists and roughly what it is. It's an individual retirement account where you invest yourself or roll over from a Roth 401k. You contribute with after-tax money, so it is taxed at some point. You're 100%. And as long as you withdraw in retirement, it's tax-free. They let you put in $7 or $8 grand a year. I think it's $7,500, $8,600. This year you can put in for a maximum. For me, for my clients, where this really fits is someone who is a high income earner and they want to put more money away. Right? I probably would do this first in most cases, because that's going to grow and you don't have the cost of the life insurance. If you're looking at it purely as an investment, probably do that first. The fees are lower, again, no life insurance cost. But you're exposed to market losses. If the market takes a dump, you're going to be sad and keep yourself up crying all night.
You also don't have a face value to pass away.
So why do we care? I kind of talked about that. Here's why we care. Because I'd rather pay, this is a chart, if you put in 300 or over 30 years, but $250 a month. At a 10% return, it's about 600 grand, give or take. I'd rather pay taxes on this number this one. I like the analogy, I do presentations for kids sometimes, trainings for kids, and I like the analogy for the kids, if you're a farmer, you wanna pay taxes on the seeds or on your harvest? I'd rather pay taxes on the seeds. And then this, I wanted to put this one in to kind of show the power of investing young and investing sooner. It's only 10 years longer, 10 years longer, 40 years instead of 30, and that total is 1.6 instead of 590 grand. Now you put in $30,000 more, you got over $1 million.
Compounding interest.
Compounding interest, yep. The chart goes up a lot faster on this end. Questions?
I do, but there's so many, and maybe we just have to have a one-to-one.
We can do a one-to-one, yeah, for sure. I need to meet with you anyway. Yeah. Who didn't get a football?